Toys R Us didn't collapse because children stopped wanting toys. It didn't collapse because Amazon simply outcompeted it on selection or price, even though that's the story most people remember. It collapsed largely under debt payments that had nothing to do with actually running a toy store. In 2005, a group of private equity firms, KKR, Bain Capital, and the real estate company Vornado, bought Toys R Us in a leveraged buyout worth about $6.6 billion. A leveraged buyout means the acquirers borrow most of the purchase price and then load that debt directly onto the company they just bought, rather than paying for it primarily out of their own funds. From that point forward, Toys R Us owed roughly $400 million a year in interest payments alone, money that came directly out of funds that could otherwise have gone toward better stores, a real competitive e-commerce strategy, or simply staying price competitive against a rapidly growing Amazon. The company was structurally strangled years before Amazon ever needed to land a single decisive blow. Here's a detail that makes the story sting even more. In the years right before the buyout, Toys R Us had actually been Amazon's exclusive toy supplier under a partnership deal, a relationship that later collapsed into lawsuits, but one that shows Toys R Us wasn't some technological dinosaur oblivious to online retail from the start. On top of the interest payments, the private equity owners also collected annual management and advisory fees directly from the company, a standard but widely criticized practice in leveraged buyouts, where the new owners charge the acquired business for the privilege of being managed by them, regardless of how the business is actually performing that year. Some of the real estate underneath key stores was also restructured through sale-leaseback arrangements, a common leveraged buyout tactic where the company sells its own real estate to raise cash and then pays rent to occupy the same buildings going forward, trading a long-term asset for short-term liquidity and a brand new recurring expense. Employees and individual store managers on the ground were, by most accounts, often executing perfectly sound retail decisions within their own stores. The organization simply didn't have the financial breathing room left over to invest in the changes retail was clearly demanding at the time, because so much cash was already spoken for by debt service that had nothing to do with selling toys. Toys R Us filed for bankruptcy in 2017 and liquidated nearly all of its roughly 800 U.S. stores the following year, putting more than 30,000 employees out of work, many without the severance packages they'd expected, a detail that generated significant public and political backlash at the time and drew scrutiny in Congress over how leveraged buyouts distribute risk. This has become a widely cited case in business schools, specifically because the operational side of the failure was secondary to a financial structure that was imposed on the company from outside its own daily management, years before the collapse actually happened. Here's the part that gets missed if you only remember the Amazon killed the toy store version of this story. The debt structure would likely have crippled Toys R Us even in a world where Amazon barely existed, because the interest payments alone consumed the exact investment capital the company needed to compete against any serious competitor, online or otherwise. A smaller format relaunch attempt in 2019, backed by new owners under a different name, tried to bring the Toys R Us brand back into a handful of physical stores, a quiet acknowledgement that the brand itself, and even the retail concept, still had real value once it wasn't buried under the original debt load. What's genuinely worth sitting with here is how invisible this kind of constraint is from inside the organization. A regional manager watching quarterly sales numbers has almost no visibility into the fact that their real ceiling was set years earlier, in a boardroom they were never in, by a financing decision that had nothing to do with retail strategy. That's the uncomfortable generalization for anyone leading a team inside a larger organization, whether that's a corporation, a nonprofit, or a government agency. A capital structure, or a budget decided somewhere far above your own level, can quietly determine your actual ceiling long before any decision you personally make ever gets the chance to matter at all. This shows up in far smaller, far more mundane versions inside ordinary companies too, not just billion-dollar leveraged buyouts. A department that inherited a legacy multi-year software contract, or a team saddled with a fixed headcount commitment made by a previous leader 2 reorganizations ago, can find a huge share of its annual budget already spoken for before a single new initiative gets proposed. The manager running that team might genuinely be making excellent day-to-day decisions and still watch the team underperform, for reasons that trace back to a financial commitment made before they ever took the role. The lesson isn't that debt or fixed commitments are always bad. Leverage and long-term contracts fund real growth all the time, including plenty of leveraged buyouts that work out fine for everyone involved. The lesson is that the terms of a financing structure or a legacy budget commitment deserve the same level of scrutiny as any strategic decision, because they silently cap what strategy can actually accomplish afterward, no matter how good that strategy is. So here's the practical move for anyone stepping into a leadership role over a team, a department, or a company. Before agreeing to any major financing structure, or before accepting a budget you didn't personally negotiate, ask exactly how much of next year's resources are already spoken for by fixed obligations alone, regardless of how well the business or the team actually performs. If that number is large enough, it tells you something the operational metrics never will: how much room you actually have to make the decisions everyone will later judge you on. Toys R Us employees were making sound calls right up until the end. The debt made sure it never mattered. One more detail worth knowing here, because it directly contradicts the popular narrative. Toys R Us also owned Babies R Us, a genuinely strong, well-regarded chain in its own category, and it was liquidated right alongside the parent brand, not because the baby products business was struggling on its own merits, but because it sat inside the same debt-loaded corporate structure. And in the years right after Toys R Us liquidated, overall toy sales in the United States didn't collapse at all. Walmart and Target both reported picking up a meaningful share of the toy business that Toys R Us left behind, which is strong evidence that the underlying demand for toys was never the problem in the first place. Toys R Us is often mentioned in the same breath as Sears, another major American retailer that spent its final years loaded with debt and real estate maneuvers under a hedge fund-affiliated owner. A broader pattern of financially engineered retail collapses that business commentators have written about extensively as a distinct category of failure, separate from ordinary competitive decline. The public backlash over the lost severance payments was significant enough that some of the private equity firms involved, facing sustained pressure and negative press coverage, ended up contributing to a multi-million-dollar relief fund for former employees. A rare instance of public reaction actually changing the outcome for workers after a leveraged buyout collapse, though only after the damage of thousands of lost jobs had already happened. That detail matters for a manager thinking about this story, because it shows the interest payments weren't some abstract accounting footnote. They were, in a very direct sense, the same pool of money that would otherwise have funded the severance, the store investments, and the competitive pricing that might have kept the company alive. Financial analysts sometimes describe this kind of arrangement using the term covenant-lite, a loan structure with fewer built-in protections and fewer restrictions on how aggressively a company can be loaded with debt relative to its actual cash flow, a structure that became increasingly common across the retail industry in the years following the Toys R Us deal. For a manager or executive evaluating any financing arrangement, the specific covenants and restrictions attached to that debt matter just as much as the headline interest rate, because a loosely structured deal can look cheap on paper while quietly removing the guardrails that would otherwise have forced a correction long before the company reached a genuine crisis. If you're a manager trying to actually apply this rather than just enjoy it as a story, Here's a concrete three-part check before accepting any budget, contract, or financing structure you didn't personally design. First, ask what fixed obligations already exist against that budget regardless of performance. Second, ask who negotiated those terms and whether they're still around to explain the original reasoning. Third, ask what percentage of a bad year would still have to go toward those obligations, even if your team executed everything else perfectly. If that third answer is large, you've just found your real ceiling, months or years before a bad quarter would have shown it to you the hard way. There's a broader point buried inside the Toys R Us story that applies well beyond retail or leveraged buyouts specifically. Anytime a business decision is made by people who won't personally live with its day-to-day operational consequences, there's a structural risk that the decision optimizes for something other than the operational health of the business itself. The private equity owners who structured the Toys R Us buyout were optimizing for a return on their own investment within a specific multi-year window, a completely rational goal from their position, but one that didn't automatically align with keeping the underlying retail business healthy over the long run. That same structural gap shows up in far more ordinary corporate settings. A cost-cutting initiative decided at a level well above a specific team, aimed at improving a company-wide metric for a specific reporting period, can quietly damage that team's ability to actually deliver its own core work, especially if the people setting the target never have to personally absorb the operational fallout of hitting it. The lesson from Toys R Us generalizes cleanly here. Whenever you're on the receiving end of a decision made by people insulated from its daily consequences, it's worth explicitly asking what that decision is actually optimizing for, since it may not be the thing you'd assume by default. There's also a lesson here for the specific people who do the negotiating in a deal like this, not just the ones who inherit its consequences. Whenever you're the one structuring an arrangement that someone else will have to operate under long after you've moved on, the honest question worth asking yourself is whether the terms you're setting would still feel reasonable to you if you were the one who had to run the business under them for the next decade, not just the next fiscal quarter. That single mental exercise, imagining yourself on the other side of the table you're currently sitting at, is a cheap, private check that costs nothing and would have flagged the exact structural problem that eventually sank Toys R Us, years before any store ever closed. The retail industry took real lessons from this case in the years that followed. Analysts and industry publications began paying far closer attention to a retailer's debt load and interest obligations relative to its cash flow, not just its sales figures and market share, precisely because Toys R Us demonstrated so clearly that a business can look competitively fine on the sales floor while quietly dying from a financial structure imposed from somewhere else entirely. If you manage anyone at all, the version of this lesson worth actually carrying forward is simple. The health of the team you're responsible for is never fully described by the metrics you personally control day to day. Somewhere above you, a decision made years ago, or a decision being made right now in a room you're not in, may already be setting the real ceiling on what your best possible year looks like. Asking about it early costs you one uncomfortable conversation. Finding out about it late costs everyone their jobs. There's one more angle worth naming directly, since it's the part of the Toys R Us case that makes it more than just a cautionary tale about one industry. Leveraged buyouts themselves aren't inherently destructive. Plenty of them successfully fund real turnarounds and genuine growth for the companies involved. What made the Toys R Us version specifically dangerous was the size of the debt relative to the underlying business's actual cash generation, at the exact moment that business faced a serious, well-known competitive threat from e-commerce. The same structure applied to a company in a stable, slower-changing industry, facing no comparable disruption, might well have worked out fine. Context, specifically how much margin for error a business actually has left over once its fixed obligations are paid, is what turned a common financial technique into a fatal one in this particular case. It's worth being precise about who actually bears the risk in a structure like this, because it's rarely evenly distributed among everyone involved. The private equity firms that financed the Toys R Us buyout had already recouped a substantial portion of their original investment through dividends and fees well before the bankruptcy filing, meaning their financial exposure to the eventual collapse was considerably smaller than the exposure carried by employees who lost jobs and severance, or landlords and suppliers left with unpaid claims. That asymmetry, where the people who structure a deal often carry less downside risk than the people who simply work inside the business afterward, is a pattern worth watching for anywhere a major financial restructuring is proposed, well beyond the specific case of a single toy retailer. Anyone sitting across the table from a proposed restructuring, whether that's a merger, an acquisition, or simply a new financing round for your own company, owes it to the people who will actually operate under the new terms to ask this same question directly. Who exactly carries the downside if this doesn't go as planned? And does that match who's making the decision to move forward with it? If the answer is that the decision makers and the risk bearers are two very different groups of people, that gap deserves real scrutiny before anyone signs anything. None of this means every leveraged deal deserves suspicion by default. It means the specific question of who bears the actual downside deserves a direct, explicit answer before anyone signs, rather than being left as an assumption everyone quietly hopes turns out fine, since hope is not a financial control, and it has never once protected a single employee's severance check. When a heavily indebted company finally runs out of room, no matter how many optimistic projections got everyone comfortable enough to sign the deal in the first place. And no matter how confident and thoroughly reasonable those exact same projections genuinely sounded to every single person sitting in the room at the time. Follow along for more of these.